Good morning. Glad to have you back with us. As I promised, we're going to go ahead today and talk about some more advanced tax planning and business structuring assets and things that we can do at this point. And so we're going to start with what if, okay, let's say that your asset mix is you've got 2 or 3 properties in California, you have 2 or 3 properties in Texas, you have an investment account, and you have an online business, okay? So we're going to sit there and say that's what we're working with. Now you've got all kinds of other things you've got that you want to protect, and we already have talked about how we do that. But what do we do with this multi-state option, okay? So this is what we're going to do. First of all, we're going to look and see where you live. Now, if you live in California, you're still going to end up with an FLP, a family limited partnership, because anything that is in California has what we call nexus with California. Nexus just means it's touching California, and if you touch California, you get to pay California taxes. That's the rule in California. And so having an entity in Texas or Wyoming or Florida or someplace else that has California property, and it's not going to really do you a lot of good. You're going to say pay the same taxes. You're still going to have the $800 franchise tax every year. It's not going to help us very much. And so it's going to be better to have a California entity for California property. So in this case, what is California that we own? Well, we have the 3 properties. So we're going to go ahead and put that into a California limited partnership. Okay, what about your investment account? Well, investment accounts can be anywhere, to tell you the truth, because most of the time you're invested with a company that works anywhere. And so we'll either put it into the California limited partnership or create its very own LLC in a different state. So so at this point, you've got your trust, of course, that's always the foundation. We now have your limited partnership for your California assets. We possibly have a out-of-state entity, LLC, for your excess monies and your investment account. And then you've got these properties over in Texas. What are we going to do with that? Well, we're probably going to open an LLC to act the same as the California FLP to take care of the properties in Texas. So you're going to have an LLC over here in Texas to make sure we have all of our properties there in Texas. We have our California FLP to have all of our California properties. We probably have an LLC that's going to hold other money assets or things that aren't necessarily attached here to you in California. And so we need to talk about how the money flows and everything to see if there's going to be nexus or not. But there's ways to make sure that there may not be any nexus with California because you never bring that money into California. So now what we do is, of course, the California FLP is going to have that little Wyoming LLC as the general partner. So you now have basically 3 LLCs, 1 FLP, and you have the trust. Now, you've got these properties that you're going to be managing. You're going to be renting these out. You're going to be finding renters. You're going to be taking care of the maintenance on them. So there are some people that will add to this mix a corporation so that actually manages all the properties. Just like if you were to go out and hire a property manager, they're their own business. And you could have your very own business to give you some tax benefits and a little bit of liability protection by having it separate from the ownership entities of the properties themselves. So in this case, this is what would happen. The corporation, it rents out the properties. The renters in the Texas and California properties pay this corporation to rent the properties. The corporation will take out its cut to be able to take care of its costs, flows down the balance of the rents to the LLC for Texas, FLP for California. That way, those monies are still tax-free. We haven't had to pay tax on those rents yet. Okay, we can now either use those monies to upgrade or fix or maintain or pay expenses on the properties, or we have excess monies that we now have, we can do other things with, such as we mentioned before, go on trips. We go pay for auto expenses, pay for eating out, doing different things that you want to do with this money. Because it has not been taxed yet, we have this little pot of money in Texas, and we have this little pot of money in California. And we legally use it for tax-deductible expenses so that maybe we'll use it all up. Who knows? If not, then at the end of the year, the Texas LLC and the California FLP give us a K-1 that says this is the part of the profit that you didn't use up this year. This is what you're going to pay tax on. So by doing that, we're able to accomplish, number one, some nice tax benefit opportunities, but we're also making sure that the properties are totally protected. So the California properties are protected by the FLP. Remember, it has the charging order option only, so that if somebody wants to come after your properties, they're going to have to take that charging order instead of take your FLP interest. And on the Texas LLC, we're going to have the same charging order opportunity so that they won't be able to touch that. Now, why put them in different places? Because you know, as you learned from your mother when you're 4 years old, you never put all the eggs in the same basket. By doing that, if you drop the one basket, everything's gone. If you don't want all the apples in one barrel, because if one goes bad, it's going to spoil all the apples. Having them separated makes sure that liability from California properties are not going to affect the Texas properties and vice versa. So we separate some liability, we get some tax benefits, we're able to have an easy to run and easy to maintain structure, and you're ready to go. So there's another option we do when we have properties from out of state. So next time we're going to get a little bit more sophisticated by adding additional states into what we're doing and different purposes. So tune in at that time and we'll show you what the next step up is if you need to take that step. If you may not, maybe this is all that's going to need to be done, or maybe just the simple process of having a trust, a limited partnership, and an LLC is all you need. You can never know until you actually meet with your legal advisor to find out what's going to be best in your case. But we're giving you some ideas of what you might be able to do.